Despite strong performance in the market, with the Dow actually jumping in 1 week's time, for the week ended December 2nd, 2011, we saw a 787-point increase. Again, that was the largest that we've seen in 3 years, and also a very strong non-farm payroll report. Investors actually took risk off their portfolios. However, they did add a considerable amount of money to the conventional fund business by injecting about $24.9 billion into the conventional fund business for the week ended December 7th, 2011. Hi, welcome to the Lipper Fund Flows Insight Desk. My name is Tom Roseen, and we're going to talk a little bit about how those flows came about and what the big important trends were. In fact, if we take a look at the macro groups, we can see that the equity funds saw a $4.8 billion outflow, which was fairly significant. Taxable bond funds on their very merry way again, up $3.4 billion, so they attracted some good inflows. And probably one of the bigger stories I think this week was muni bond funds taking in $1 billion. That's a near record number, at least for quite a few weeks. And then money market funds, here's where the lion's share of the money came from. $25.3 billion came into the money market industry. Well, if we're actually taking a look at the breakouts and we want to go into kind of a more finite detail, we look at equity funds, we see that in fact investors basically took it on the chin. Equity funds saw about $4.8 billion in outflows. However, as a return goes, Wednesday to Wednesday returns, we saw a 73 basis point return. So really a positive return, nothing big to write home about, but positive return. But again, investors are so concerned with the European debt crisis, on again, off again, and the story going on and on, that this was the 5th consecutive week we've seen outflows, and this was $4.8 billion in outflows. On the domestic equity side, we saw about $4.4 billion in outflows, and on the non-domestic equity side, we saw about $400 million in outflows, bringing it to the grand total of 4.8. Interesting enough, though, if we take a look at equity income funds, we saw about $405 million in net new money come into the equity income funds. Investors are still looking for that dividend distribution. They're looking for that yield, and that's what they're willing to pay for. So again, $405 million in equity income funds just been going on their merry old way, and it's been something we've been talking about for quite some time. Interesting enough, even with the crisis going on, and we'll call it the European debt crisis, obviously, emerging market funds took in $247 million. So when we're looking at that, people are still making a bet of growth going on in China, India, and those type of areas that actually are going to support Chinese growth. And so we are seeing money going in there, but again, they are fleeing from domestic equities. Saw about $2.7 billion now from large cap funds. Interesting though, if we would have included ETFs into our numbers, it would have been a whole different story. A tale of two cities. We saw about $8.8 billion, let's call it $8.9 billion of net new money come in via the equity funds, via the ETF instrument. So that's a considerable amount of money. However, SPY accounted for almost all of it, $7.2 billion. QQQ took in a little bit under $1 billion, about $900 million is what it took in. But overall, again, tale of two cities. Those investors willing to take on that risk, see some opportunities from some of the selling that's been going on from people being scared off by the European debt woes. Certainly looks like institutional players are coming in on the equity side and snatching up what they're considering some good buys. Well, that brings us to our fixed income universe. In our fixed income universe, we've actually seen the 8th week in 9 where we've seen positive flows, and we saw about $3.4 billion inflow this week, and we also had some strong returns, 0.55% return for 1 week period of time, certainly nothing to scoff at. Corporate high yield funds, though, saw about $1.3 billion in inflows. Corporate investment grade debt funds saw about $1.2 billion, and government mortgage funds saw about $600 million in inflows. So when we're looking at this, you kind of say, well, listen, people weren't that scared, were they? Well, I believe they are, but they do not want to go to treasuries. They're just not yielding enough. So they're willing to go out on that yield curve. They're willing to take on a little bit more risk, and they're willing to, again, search for yield. They're not necessarily going in treasuries. So that's been part of that story. Well, interesting enough, when we're talking about playing the yield game and looking for returns, municipal bond funds actually coming to mind. We've got to start thanking Meredith Whitney, actually, because she basically took the rug out from underneath munis, caused them to go way down, and with that going way down, we've seen yields appreciate, we've seen good, strong returns, and in fact, for the 3rd week in a row, we saw positive returns. This week was one of the strongest, with 70 basis points return on the muni bond fund side. It's the 8th week and 9th that we've seen inflows, so another strong week. But here's where maybe the story is. We saw $1 billion in inflows, and of that, 831 million went into national munis. That's the largest inflow since April 20th, 2011. So we've seen, again, a strong muni bond market. We've seen good yields coming out there, especially if you start taking a look at after-tax tax equivalent yields. And certainly they've had a fairly strong inflow piece. And again, investors have enjoyed some very strong returns year to date. Well, that brings us to the money market dilemma, and people are putting them in, and when they take off risk, they're putting in money market funds. They when they are putting on more volatility, they're pulling money out. Well, this time we saw $25.3 billion in inflows. It's the second week in a row that we've seen inflows. Taxable money market funds saw about $19.5 billion in inflows, and of that, 16.4 was institutional money, 3.1 billion was retail or retail investors. So we know at the end of quarters, at the end of the year, we have treasurers who are basically trying to put either money back to work, or they're going to have to pay some 401k liabilities, whatever the case may be. So they park this money for a short period of time. We will not be surprised over the next week or two or three where we see fairly significant outflows out of the money market funds. Tax-exempt money market funds also saw some big inflows, $5.8 billion, strongest inflow into this group since January 5th of 2011. Well, that's kind of the story of what's going on. We saw today and yesterday actually some pretty good news. We saw that new claims for jobless benefits declined to 381,000. That's the lowest it's been since July of 2008. Same-store sales have been on a rise. We've also heard some very good numbers on retail sales for this pre-holiday season, and so things are looking very strong at that. And just this morning, and it really was from last night, we saw that European leaders agreed on closer fiscal ties. Well, this is going to be that risk on, risk off that we're going to keep on facing for quite some time until this dilemma over in Europe is taken care of. And believe me, this is probably not the last we've heard of it. The UK is not liking the idea of having closer fiscal ties with the rest of Europe, and there are some other nations also griping about it as well. So again, risk on, risk off. Well, if you want to do a little bit more research, dive deeper to see what's happened in your groups that you're following, you can certainly go to our fund site. It's called Lipper1s U.S. Take a look at our fund flows for that particular product that you're taking a look at. If not, you can join us next week where one of our analysts will talk to you about flows in your neighborhood. Until next week, my name's Tom Roseen, wishing you the best in your wealth planning and creation.